You pull up to the gas station, you step out, you grab the nozzle, and as you start pumping, you just watch those little digital numbers on the screen.
Spinning faster and faster.
Exactly, just
Yeah.
spinning. And as that total climbs higher, you kind of stare at it and briefly wonder, is it finally time?
Like time to just give up on gas.
Right. Is it time to just bite the bullet, trade in the gas guzzler, and finally buy an electric vehicle?
Yeah, it's a thought a lot of people are having right now.
It is. And it turns out that exact thought at the pump is currently colliding with, well, a massive $70 billion corporate blunder, honestly. And on top of that, a geopolitical crisis in the Middle East.
It's a pretty wild collision of events.
So today we are doing a deep dive into this volatile intersection of global geopolitics and the automotive industry. Specifically, we're looking at how the escalating conflict in Iran is sending just absolute shockwaves through the electric vehicle market.
Yeah, and we've got a lot of good data to look at for this.
We do. We're pulling from a stack of recent financial analysis, some really interesting insights from Edmunds and Cox Automotive, plus market reports from March 2026. Our mission here is to just kind of cut through the panic-induced headlines, to figure out the actual math behind consumer behavior during a geopolitical crisis.
Right, because the headlines can be a bit much.
Oh, they're everywhere. But we want to know, does a sudden spike in gas prices actually save the EV market? Or is it just a mirage?
Well, to understand the sheer whiplash of this current crisis, we really have to look at the baseline of the auto industry, like right before this geopolitical shock hit.
Okay, set the scene for us.
So the industry was not in a state of stable transition at all. It was actually in the middle of a massive panicked retreat.
A retreat from EVs.
Exactly. Legacy automakers, the traditional giants who've been building combustion engines for a century, they were aggressively pulling back from electric vehicles.
Wow.
Yeah, if you look at the financial reports from Honda, Ford, General Motors, and Stellantis, just those four companies alone recently racked up a combined restructuring bill that's nearing $70 billion.
Wait, 70 billion?
Yeah, almost $70 billion.
I mean, let's actually visualize what a $70 billion restructuring bill looks like, because that is a really difficult number to just, wrap your head around.
Yeah, for sure. It's massive.
That isn't just like a penalty fee paid to a bank. That is the physical cost of tearing up the floorboards of their own future.
Right. It's physical infrastructure.
Yeah. We are talking about halting construction on massive battery plants, like halfway through the build. It means paying exorbitant severance packages to engineers they literally just hired.
Yeah, the human cost of the pivot.
Exactly. And it means physically ripping out the specialized robotics designed for EV assembly lines and then paying to reinstall the old tooling for gas-powered SUVs.
Which is incredibly expensive.
Right. They looked at the landscape, saw that consumers, weren't adopting EVs at the mandated pace, and spent an absolute fortune to just slam on the brakes.
And, the irony of that timing is really what makes this current moment so critical.
How so?
Well, the explicit purpose of that $70 billion retreat was to insulate themselves from a sluggish EV market, right?
Yeah.
To wait until the infrastructure and consumer demand were actually ready.
Okay, that makes sense on paper.
Right. They essentially placed this massive financial bet that gasoline-powered vehicles would remain the undisputed king of their profit margins for, well, at least another decade.
Wow.
And so they oriented their entire global supply chain to support that bet.
Which, okay, that brings me to this analogy. Imagine you just spent an absolute fortune perfectly winterizing your house.
Okay, I'm following.
You bought the heaviest insulation, you sealed every single window, you installed this massive furnace, you drain your entire savings account preparing for a deep freeze.
Right.
And then the very next morning, a record-breaking summer heat wave hits.
Oh, man, yeah.
You are trapped in a house built for the exact opposite of your current reality. And with gas prices now threatening to spike because of this conflict in Iran, it seems like these legacy automakers are completely caught flat-footed by their own $70 billion U-turn.
That's a really great way to put it. The tension here is between long-term corporate inertia and, well, the brutal speed of global events.
Because cars take a long time to build.
Exactly. Changing factory tooling and renegotiating international supplier contracts, that takes years. But a geopolitical crisis, that can choke off the global energy supply in an afternoon.
Yeah, no kidding.
These monolithic companies spent tens of billions of dollars navigating away from EVs, but global conflict, it doesn't check a corporate earnings calendar before it escalates.
It definitely doesn't. And the mechanism causing this sudden heat wave, to use the analogy for the auto market, it comes down to a very specific physical bottleneck on the map.
Right.
We aren't just talking about abstract global tensions here. We are talking about the Strait of Hormuz.
Yeah, the Strait of Hormuz is one of the most critical arteries in the entire global economy.
It's tiny, though, isn't it?
Very tiny. At its narrowest point, it's only about 21 miles wide. And the actual shipping lanes within it are even narrower than that.
Wow.
Yet, according to the sources we're looking at, roughly 1/5, so 20% of the world's entire oil supply travels through that specific channel.
20%. That is wild.
It is, and Iranian officials have explicitly stated they will not allow ships through this critical passage.
Okay, so shutting down 20% of the global oil supply obviously creates immediate ripple effects, but the data shows those ripples hit different automakers in drastically different ways, right?
Oh, absolutely.
Yeah.
The impact is not evenly distributed.
Right. So we have to look at the localized direct impact first. The reports point out that Chinese automakers are currently the most directly exposed to the fallout in the Middle East. They've been expanding internationally at this blistering pace, and their showrooms and distribution networks are suddenly sitting in a highly destabilized zone.
Yeah, and the reason Chinese automakers are so heavily concentrated there is really crucial context for this whole thing.
Why are they so focused on the Middle East?
Well, domestic vehicle sales within China have kind of reached a saturation point, and that's been accompanied by this really intense price war at home.
Okay.
So, to survive, Chinese brands had to look outward. But Western markets, like the US and parts of Europe, they've deployed massive tariffs to block those vehicles.
Right, the tariffs.
Yeah, so Chinese automakers aggressively targeted emerging markets instead, and the Middle East became a primary focus.
That makes sense.
They poured billions into establishing localized supply chains and distribution networks in the region. But now, this conflict acts as a physical roadblock to their entire international growth strategy.
Because you can't sell cars in a war zone.
Exactly. They simply cannot move inventory in a region paralyzed by conflict.
But the sources also note that domestic automakers, the big guys in Detroit, they have a completely different footprint.
Very different, yeah.
Ford and GM have a minuscule presence in the Middle East compared to the Chinese brands. I mean, some domestic brands have almost zero market share there.
Practically none, right?
So on paper, the analysis suggests Detroit is fairly protected from the direct regional impacts of the conflict. Like, they aren't going to see a massive drop in localized sales because, well, they weren't making their money in Tehran to begin with.
Right. From a purely localized sales perspective, that is the reality. The physical showrooms in the conflict zone do not belong to Detroit.
Okay, I have to challenge this idea of Detroit being safe, though.
Go for it.
Because if we look at the mechanics of how oil prices actually work, Detroit's lack of dealerships in the Middle East seems kind of irrelevant.
How so?
If 20% of the global oil supply is choked off in the Strait of Hormuz, the baseline price of a barrel of crude oil skyrockets globally.
Yes, that's true.
And that global spike translates instantly to the physical gas pump in Texas or Ohio or Florida. And Detroit's most profitable products, the vehicles that actually keep their lights on, are these massive internal combustion engine trucks and SUVs. If the fuel for those specific vehicles suddenly becomes unaffordably expensive for the American consumer, Detroit's core domestic market is essentially collateral damage.
That's a really good point.
Right. Like, they aren't protected at all. They've just outsourced their risk to the consumer's wallet.
Well, that is an excellent dissection of the macroeconomic reality here. We really have to separate direct market exposure from indirect macroeconomic exposure.
Break that down a bit.
Sure. So direct exposure is having a factory or a dealership sitting right in a conflict zone that is China's problem right now.
Right.
Indirect exposure is having your entire business model predicated on a resource that is suddenly trapped behind a military blockade.
The oil.
Exactly. Detroit's vulnerability is entirely domestic, but it is triggered by these international events. Because if the cost of operating a full-size pickup becomes prohibitive, the Detroit profit engine basically stalls.
So the pain at the pump becomes the great equalizer.
Precisely.
The physical location of the dealership doesn't even matter if the consumer can't afford to drive the product off the lot.
No, it doesn't.
So since Detroit is vulnerable to that localized pain at the pump, we have to look at how the actual consumers are reacting to these initial gas price spikes.
Right, the human element.
Yeah. Are they bailing out of those big trucks and rushing to buy the EVs that automakers just spent $70 billion trying to cancel?
Well, the automotive research company Edmunds actually provides some really fascinating behavioral data on this.
Oh, what'd they find?
They observed a distinct visible spike in consumer research for electric vehicles and hybrids on their platform starting on March 2nd.
March 2nd. Okay, that is not a coincidence. That was just days after the initial strikes were launched in the region.
Yeah, the timeline is practically instantaneous.
The evening news breaks the story, geopolitical tension spikes, gas prices start ticking upward, and the immediate reflex of the American consumer is to jump online and start researching electric cars.
It really is.
It's like the digital manifestation of that helplessness at the gas pump.
Yeah, it's a search for agency, really.
Yeah.
When a macroeconomic force dictates the cost of your daily commute, researching alternatives kind of restores a sense of control.
That makes total sense.
But the data does require a pretty severe reality check. We have to measure the distance between researching a massive lifestyle change and actually executing it.
Oh, absolutely. I look at this Edmunds data the same way I look at web traffic for gym memberships on January 1st.
Oh, that's a perfect comparison.
Right. There's this massive spike in intent. People feel sluggish after the holidays. They go online, they look at the pristine photos of the treadmills, and they imagine a totally different version of themselves.
Yep.
That is what I call panic Googling. But researching a gym membership from your couch is a completely different universe than walking into the facility, handing over your credit card, and signing a non-refundable 12-month contract.
100%.
We have to figure out if these consumers are actually signing the contract for an EV.
And the historical data provided in the market analysis gives us the exact blueprint for how this usually plays out.
Okay, what does history tell us?
The analysts point us back to June 2022, following Russia's invasion of Ukraine.
Right, another huge energy shock.
Exactly. That was a severe geopolitical shock that disrupted global energy markets and actually sent the national average for gasoline in the U.S. to $5.01 per gallon.
Wow, $5 a gallon. That is a massive psychological threshold.
Literally is.
It just breaks the mental budget people have for their weekly commute. When gas hit that $5 mark in 2022, I would assume the market for gas-guzzling trucks just completely collapsed, right?
Well, the assumption makes logical sense, but the data tells a totally different story.
Really?
Yeah, according to Automotive News, sales of highly profitable full-size pickups and SUVs did decline in 2022, but only by 7.3% for the year.
Wait, only 7.3%.
Just 7.3%.
I mean, a $5 gallon of gas is incredibly painful for someone driving a vehicle that gets like 15 miles to the gallon. A drop of less than 8% seems impossibly low for that level of financial pain.
It does seem low.
Ugh.
But to understand why the drop was only 7.3%, we have to look at the entrenched utility of those specific vehicles.
Utility meaning what they're used for.
Exactly. A significant portion of full-size truck sales are fleet purchases. Contractors, plumbers, construction companies.
Right.
They cannot do their jobs in a compact hybrid. Furthermore, the retail buyers of these vehicles often use them to tow boats, haul trailers, or transport really large families.
They need the size and power.
Right. A $5 gas price inflicts financial pain, sure, but it does not erase the physical requirement the consumer has for the vehicle's capability.
That makes sense.
They absorb the cost. Because the alternative, not being able to do their job or transport their family, is just worse.
And a 7.3% drop in combustion vehicle sales does not automatically equal a 7.3% increase in EV sales anyway.
Exactly.
The people who delayed buying a truck didn't necessarily go buy a Tesla. They probably just held on to their old truck for another year.
Yeah, the intent is there, as the Edmunds data shows, but the financial commitment is just a formidable barrier. It really comes down to fundamental consumer economics.
Let's break down the math of that barrier, because buying an EV to avoid expensive gas is a massive financial paradox.
It really is.
You are staring at a $5 a gallon gas problem. It might be costing you an extra $100 or even $200 a month at the pump.
Right.
The proposed solution to that problem is to go out and purchase a new electric vehicle. And the average transaction price for a new vehicle right now is hovering around $50,000.
Which is huge.
So the consumer is being asked to take on a $50,000 auto loan at current relatively high interest rates simply to solve a $200 a month fuel problem. The math is completely upside down.
Totally upside down.
Yeah.
In the short and medium term, humans seek the path of least economic resistance. Taking on a $50,000 liability is the path of maximum resistance.
Yeah.
It's far easier and significantly cheaper to simply alter your daily behaviors.
Like what? You cancel the weekend road trip.
Exactly.
You organize a carpool for the morning commute. You combine 3 separate errands into one optimized trip. You might even negotiate an extra work-from-home day with your employer.
Yep.
All of those behavioral changes require absolutely zero capital investment. You are absorbing the geopolitical shock through lifestyle friction rather than financial leverage.
Exactly right. The behavioral adaptation is the buffer between the geopolitical shock and the automotive sales data.
But there has to be a limit to that buffer, right?
Yeah, there is. A 2022 study by Cox Automotive actually investigated the limits of that buffer. They wanted to identify the exact threshold where behavioral changes are no longer sufficient to absorb the pain.
The breaking point.
Right, the point where the consumer finally capitulates and takes on the financial burden of an EV.
So they were looking for the magic number at the pump.
Exactly. And according to their extensive survey data, that magical number is roughly $6 per gallon.
$6. Okay, I have to question the permanence of that $6 figure, though.
Why is that?
If inflation is constantly driving up the underlying cost of the EV itself, that magic number can't be static. Like, if supply chain issues make that $50,000 EV cost $55,000 tomorrow, the math of the dilemma changes again.
That's a fair point.
Doesn't the goalpost for the magic gas price just keep moving further away? If the EV gets more expensive, doesn't the gas price have to hit $7 or $8 to force the transition?
Well, the fluidity of market dynamics is exactly why the Cox Automotive study includes a very specific critical caveat.
Okay, what's the caveat?
The magic number isn't just a fleeting price tag. It hinges on the word sustained.
Sustained.
Right. The study found that sustained prices at roughly $6 per gallon relative to the current vehicle pricing of the time, of course, is the catalyst that pushes shoppers from simply researching to actively buying.
Define sustained in this context. Like, how long does the pain have to last before the consumer finally breaks?
So a brief spike to $6 or even $7 a gallon for a week or two, that will not fundamentally alter overall vehicle volume and demand.
Because people think it'll go back down.
Exactly. Consumers are acutely aware that geopolitical panics often cause temporary, volatile spikes in energy markets. If the price spikes for a week, they'll simply park their cars, cancel their plans, and grit their teeth until the market stabilizes.
Right.
It takes a prolonged period, we're talking months, perhaps consecutive quarters of conflict-driven gasoline price increases to convince a consumer that the high price is the permanent new reality.
They have to believe the pain isn't going away.
Exactly. They must internalize the high price as a permanent fixture of their economic life. Only when the consumer believes the $6 gallon is the permanent baseline will they justify the massive capital layout for an electric vehicle to escape it.
Wow.
And currently, the impact of the Iran conflict on the oil markets is still in its early volatile stages. Gas prices only began rising sharply just before these reports were issued.
So we aren't at sustained yet.
No, not yet. So right now, the circumstances are pushing education, anxiety, and research. They are not yet pushing signed contracts for $50,000 vehicles.
When you pull all these threads together, the sheer scale of the forces at play is just staggering.
It really is.
You have the monolithic legacy automakers, Ford, GM, Honda, spending $70 billion to physically dismantle their electric vehicle infrastructure, essentially betting their survival on the continued dominance of the gas pump.
A massive bet.
And then, almost immediately, the geopolitical map fractures. A conflict in the Middle East threatens to choke off 20% of the world's oil through a 21-mile-wide strait. The resulting pain at the local gas pump instantly triggers a massive wave of consumer curiosity, sending them straight to Edmunds to find a way out.
But, as we saw, the historical data from 2022 proves that curiosity is heavily insulated by consumer habits.
Right.
Until gas hits a sustained, prolonged $6 a gallon, the average person will simply drive less before they take on the debt of a new electric car.
And understanding the gap between those search trends and the actual sales data is critical for cutting through the noise of these crisis-driven headlines. Panic Googling does not equal a market revolution, and a $70 billion corporate strategy can be completely derailed by a single blocked shipping lane.
It's all connected.
It really is. We leave you with a lingering question to ponder the next time you're out on the road. We established that sustained $6 gas is the magic number required to force mass EV adoption. If that is true, are geopolitical crises and blocked shipping lanes paradoxically doing more to accelerate the green energy transition than actual automotive innovation? Next time you pull up to that gas station, grab that nozzle and watch the numbers climb. Ask yourself what it would really take to make you pull the plug on gas forever. Until next time, keep diving deep.